Hello, today we are going to talk about stocks positions after Jerome Powell's speech. After U.S. Federal Reserve Chair Jerome Powell's remarks increased bets of a slowdown in the pace of interest rate hikes. Indian shares extended their rally for the 8th consecutive session on Thursday. The S&P BSE Sussex closed at 63,284.19, up 0.29%. Nifty, the NSE Nifty 50 index, also gained 0.29% to finish at 18,812.55. During the session, both benchmarks climbed about 0.7% to new all-time highs. The Reserve Bank of India's upcoming policy decision, due on December 7th, will now be the focus of attention. According to A.K. Prabhakar, head of research at IDBI Capital, he anticipates a 2 to 4% rise for the benchmark Nifty to 19,800 to 20,000 levels by the end of the year. Market is expecting a small hike of 35 to 40 bps, but it should not have much of an impact because the inflation is cooling and crude prices have come down, he said. Prabhakar added that a significant correction could lead to a further rally in IT stocks. The largest Nifty 50 gainers were Hindalco Industries Hindalco and Ultratech Cement CMCO, both up 2.8%. The Nifty Small Cap 100 KNX Small Cap and Nifty Mid Cap 100 KNX Mid Cap performed better than their larger counterparts, rising 0.43% and 0.77%, respectively. The Clever Autofile CNX was among the slouches, hauled by year-on-year decrease in November deals for Bajaj Auto. According to a government order, India reduced the windfall tax on crude oil on Thursday to 4,900 rupees per ton. Additionally, it reduced the diesel export tax to 8 rupees per litre. According to the order, the changes to the windfall tax will take effect on Friday. After data showed a slight easing in inflation and solid consumer spending in October, hopes of a likely downshift in the Federal Reserve's aggressive rate hike policy increased. And the S&P 500 and Nasdaq opened higher on Thursday. At the opening, the Dow Jones Industrial Average DJI decreased by 56.2 points, or 0.16%, to 34533.59. At the opening bell, the Nasdaq Composite IXIC rose 7.2 points, or 0.06%, to 11,475.172. While the S&P 500 SPX rose 7.0 points, or 0.17%, to 4,087.14. After the rally of the previous session, major market averages opened the trading session on Thursday with mixed sentiment, but they have since fallen. Early on, the Nasdaq Composite lost 0.5%, the S&P 500 lost 0.5%, and the Dow lost 1.2%, with the S&P rising above its 200-day moving average on Wednesday. Equity sentiment appeared to be risk-on at one point in the session. Standard Chartered's Steve Englander wrote, "Powell was not overly dovish, but with his previous comments having been seen as intentionally hawkish. This set of comments anchored 50 bps as the almost certain hike on December 16 and put February 2 pricing into 50 to 50 between 25 and 50 bps, rather than heavily skewed to 50 bps. Investors saw Powell's speech as signaling that the FOMC would become more judicious in deciding future rate hikes. After falling yesterday, rates fell further. To 3.59%. The 10-year Treasury yield decreased by 10 basis points. The 2-year yield decreased by 5 basis points to 4.32%. According to Deutsche Bank's Jim Reed, traders moderated their views on the likely pace of rate hikes over the months ahead, following Powell's remarks. Terminal rate pricing down from 5.01% the previous day to 4.92% by the close yesterday. In the meantime, the rate price for the end of 2023 fell even further on the day, to 4.43%, by minus 21.3 bps. The ISM Manufacturing Index data came in at 49, which was lower than the previous reading of 52, marking the first contraction since May 2020. According to Ian Shepherdson of Pantheon Macro, the bigger picture is that the index already has fallen sharply since January, by around 8 points, and output growth has weakened substantially. This lull has been driven generally by the impacts of more tight financial approach, which still can't seem to be completely ingested. Personal spending and income increased by 0.8% and 0.7%, respectively, in October. The core PCE price index, the Fed's preferred inflation gauge, achieved plus 0.2% instead of the anticipated plus 0.3%. The forecasted 235K weekly jobless claims fell to 225K, a 16K decrease from the previous week. Among active stocks, Okta is rallying after exceeding expectations for results and forecasts. As Fed Chair Powell predicts fewer rate hikes soon, the Nasdaq, S&P, and Dow all soar. On Thursday, the global chief investment strategist of BlackRock Investment Institute stated that the asset manager was not chasing the share price rise that followed the most recent remarks made by Federal Reserve Chairman Jerome Powell. Comments made by Powell on Wednesday that suggested the frantic pace of U.S. interest rate hikes this year might be about to slow have cheered stock markets. However, Whaley stated, speaking at a BlackRock Investment Institute media briefing on the outlook for 2023, that Powell's remarks also suggested that rates would remain elevated for some time. "We are unable to extrapolate from each meeting's outcomes," she stated. None of that has changed since Powell's comments yesterday. What really matters is when rates peak and when rates are cut. That is why we are not chasing the rally at the moment. Additionally, she stated that the momentum of the dollar was likely to slow in the coming year. A member of the Prime Minister's Economic Advisory Council said on Thursday that the Indian economy is likely to grow by 6.5% to 7% next fiscal year if the global environment does not get worse, which is a higher estimate than some economists have given. Worldwide organizations like the Global Financial Asset and the World Bank, for example, have estimated India's development will be 6.1% and 6%, separately, next monetary. According to Sanjeev Sanyal, who spoke with Reuters, the country will continue to maintain macroeconomic stability despite the very difficult global environment, which is helped by the stable banking sector and buoyant tax revenue collections. Sanyal stated, in accordance with the nation's central bank's projection, "I think we are now on track to achieve somewhere slightly short of 7% GDP growth rate for this financial year." The fiscal year in India begins on April 1 and ends on March 31. Due to slowing exports and the possibility of high inflation reducing purchasing power, economists had reduced their projections for India's growth in fiscal 22 to 23 to approximately 7% earlier this year. Despite this, the Organization of Economic Cooperation and Development predicts that the Asian nation's economy will continue to grow at a slower rate than any other G20 nation in the current fiscal year, trailing only Saudi Arabia. Sanyal stated that the manufacturing sector will require support from weak external demand and that India's supply side is capable of growing further. He went on to say that demand prospects in the medium term are good because private sector investments are starting to show up in the domestic economy. However, the official data provided by the government indicate that exports have begun to suffer as a result of slower global growth. In October, exports decreased by nearly 17% year-over-year. Sanyal asserted that an invest and export strategy will further propel the economy. He stated that India intends to strengthen its physical infrastructure, negotiate free trade agreements with developed nations, encourage local production, and position itself in global supply chains. India has recently signed a trade agreement with Australia that will go into effect on December 29. It is also in advanced negotiations with the UK, among other countries. Additionally, India has agreed to restart talks with the Gulf Cooperation Council. Thank you for watching. For more financial news and info, don't forget to hit the like and subscribe buttons.